Rates just went the wrong way again, and this time it wasn't just the jobs report or CPI. It was two things: a brand new Fed chair's first set of meeting minutes and a war that won't stay inside its ceasefire. Here's what moved this week and what it actually cost you at the closing table. Wednesday, the Fed released the minutes from Kevin Warsh's first meeting as chairman. The committee held rates steady at 3.5 to 3.75%, 12 to 0. But the minutes told a more interesting story than the vote did. Few officials said there was a real case for hiking right then. They didn't win the argument, but the fact that the case got made at all tells you where the committee's head is. Inflation concern is building, even as the labor market cools. Warsh also cut the post-meeting statement down to 130 words, about a third of what we're used to seeing, and stripped out forward guidance entirely. He's not signaling a path. He announced 5 task forces to review how the Fed operates, from communications to how it reads inflation data. Translation: don't expect the Fed to tell you what's next. You have to plan for a range, not a number. Here's a number that actually hits your loan quote. The 10-year Treasury opened the month at 4.49%. By Thursday, it was trading around 4.58, a 7-week high, before easing slightly to 4.54 to 4.56% on Friday. The driver isn't the Fed directly. It's the Strait of Hormuz. The U.S. carried out a second day of strikes on Iran this week, and crude jumped back above $73 a barrel on the news. That reignites the same inflation expectations trade we've seen all year. When energy costs threaten to spike, long bond yields move first. One more data point that matters for your tenants' customers: gas prices had been falling steadily since late May, giving households a break over the 4th of July. That reversed this week. The national average ticked back up 5 cents to $3.84 a gallon as the ceasefire looked shakier. Here's the Texas angle. We're still sitting near the cheapest gas in the country, around $3.41 to $3.42 a gallon. Our tenants' customers have real breathing room compared to a shopper in California paying $5.38. That's a genuine cost of living edge, and it shows up in discretionary spending at your strip center. The deal math. Let's run the actual mechanics. Take the 10-year at roughly 4.56%. Add a typical lender spread for a retail strip center, call it 175 to 225 basis points. That puts your loan rate somewhere between 6.31 and 6.81, depending on sponsorship, leverage, and tenant mix. That's not a small range. On a $5 million loan, the difference between the low and high end of that spread is real monthly debt service, and it flows straight through to the debt coverage ratio and your cash-on-cash return. If you're underwriting a refi or a purchase right now, run it at both ends of that range, not just the number your lender quotes you today. So wrapping this up, Warsh removed forward guidance on purpose. Plan your financing around a range of outcomes, not a bet on where your rate goes next. Rerun your DSCR at 6.5% plus before you assume a refi pencils. The 10-year 7-week high isn't priced into every lender quote yet. And here in Texas, the fuel cost advantage is a real quantifiable edge for your tenant base right now. Worth mentioning to buyers evaluating trade area strength. And that's the week. A divided Fed, a war that keeps moving the goalposts, and a gas price swing that actually favors us here in Texas. If you're sitting on a strip center and wondering whether this is a hold refi or a sell this year, that's exactly the conversation I have with owners every week. Feel free to reach out, and I look forward to seeing you next week. Take care.